Good afternoon, everybody. Paul here coming at you with a Crypto Coffee update where we're going to talk about all of the news, events, and happenings in the exciting worlds of crypto, blockchain, and digital finance. And for the namesake of the series, join me for a simultaneous sip of hot, fresh coffee. Cheers. Good stuff. All right, so let's get into the episode of the day. You can see here in front of us we have the BitcoinTradeVolume.com brought to you by Bitwise. If you recall from a previous Crypto Coffee update, we examined how 95% of reported Bitcoin by volume is fake. This is done through a process known as wash trading, which essentially allows two accounts to trade a balance back and forth, thereby simulating real market activity, but ultimately no buyers and sellers are actually exchanging goods and services they want. It is just made to appear as though there is real usability and market activity occurring in the ecosystem in hopes to attract outside investment or user participation from which investment or user fees can be taken. It's pretty shady practice. Definitely means that in the event of a large entity trying to do a successful trade on your platform, if you are doing wash trading, ultimately it may lead to insolvency, and generally this kind of activity is only undertaken by shady gray area or full-on criminal enterprises. So here we are with a more accurate idea of what the real Bitcoin volume, actual buyers and sellers meeting and exchanging at an agreed upon price, happens to be. Today, it's $311 million, which is pretty healthy, and you can see a materially significant $53 million from Bitcoin futures. Again, this is something that we've talked about plenty of times previously, and it's very exciting to see the crypto space mature as this information was handed off by Bitwise to the SEC, the full report of which you can read here. If you click the Read the Full Analysis button, it'll download right to your computer, and you can read through that 200-plus page deck that the SEC is no doubt reviewing with bated breath. Now, CoinMarketCap is the most popular data aggregation, price aggregation in particular, resource in crypto. It's been that way since about 2013, and they definitely have served the space very well. However, as you can see, $10.7 billion in Bitcoin volume means that indeed almost exactly 95% of this volume happens to be completely fake, meaning that any individual making a decision derived from this information is not making an accurate financial decision for their own well-being per se. Ultimately, it may turn out okay in the end, but if you're deriving your decision making from incorrect data, that can ultimately lead to discrepancies in outcome, something which CoinMarketCap is particularly and in part responsible for, given the display of this information. Now, luckily, it seems as though they are willing to change that and will do so. You can see here CoinMarketCap will, after listing metrics from latest fake volume research, they will alter that. So let's go ahead and move down and see that Chan, the individual representing CoinMarketCap at this point in time, he did not offer a time frame for implementing these changes. So no word as to whether or not it's going to happen tomorrow, next week, next month, or even the next couple years. No way to know. This is something that CoinMarketCap is unfortunately kind of known for. Back in 2017-2018, there emerged what is known as the kimchi principle. This is a principle on any given cryptocurrency in Korea in particular. Due to Korea's homogenous culture and just as a nation in general, they ultimately engaged in frenzied buying of particular digital assets. Ripple perhaps was the most prolific, with a 50% premium in South Korea at one given time relative to the other world's valuations. This led to a lot of discrepancies and confused users, and ultimately CoinMarketCap's solution was to simply omit Korean exchange data for a given time until the frenzy slowed down. This is in contrast to some other much smaller competitors to CoinMarketCap that included an active button that you can toggle Korean exchanges omissions on or off, meaning that if it was on, all Korean exchange data would automatically be omitted and the price would reflect the rest of the world's given average. So it just goes to show that CoinMarketCap's solutions ultimately appear at times a bit low-tech, a bit slow to appear at all, and ultimately maybe a bit roundabout. This is something that has not been lost at all on Masari, which is a rival data aggregation service, and this is from Ryan Selkis on Twitter as 2-Bit Idiot. I think his tag does himself a bit of a disservice. Ryan is an incredibly bright and accessible individual, and he is doing fantastic work for the crypto space. So here's an article called Run CMC from Unqualified Opinions by Masari. Unqualified Opinions is worth subscribing to, in my opinion. It's really fantastic. Perhaps that opinion's unqualified, but it's neither here nor there. So let's take a look at CMC and how Ryan starts out praising them, saying that they were contrarian and right about the long tail of crypto assets. As previously said, they've been doing it since 2013. They have best-in-class data sets, and they have fantastic asset coverage, and they've been an open data provider. So this is great stuff. However, their data is just wrong. Here, Ryan's outlined a lot of points about wrong data, such as the volume being completely false, Bitfinex and Tether being factored into the price. Dollar-pegged stablecoins ultimately influence the market cap, the total market cap, and it overstates the overall supply of certain digital assets by not accounting for large illiquid treasuries either held by the assets themselves, their respective firms, or prominent individuals who are known. So with that said, let's move back over to the article before we take a look at Messari's data. CMC has a rumored $100 million high margin revenue in 2017. So they have a huge war chest, but for some reason they still can't get out any significant updates. Ryan has three potential hypotheses. The team is overwhelmed, they're complacent, or the team's just not up to task. If it's number two, then it's definitely a concern for users if they're complacent. If they're overwhelmed, they definitely have a lot of money to get you some great people, so it's definitely a bit strange. And if the team's not up to task, well, again, with $100 million and what they've built previously, that doesn't seem to be the case. So likely they're just complacent or taking advantage of the situation. Take a look at what many users saw in 2017 and 2018. Ryan does a great job of getting this screenshot and sharing it with everyone to let you know that in 2017, if you're a new user looking at CoinMarketCap, unfortunately, you're going to see 3 Ponzi scheme advertisements. BitConnect, the largest Ponzi scheme in crypto history, something called Laser Online, which I've never heard of, but 12% a day is very scammy, and 4.5% from BitPetite, also a Ponzi scheme. Again, this is new users using this site on a regular basis, so definitely shady stuff. So Ryan concludes that they've done nothing in 18 months with a massive war chest. They've historically profited from shoddy advertisers, and now many other superior options are beginning to emerge, not least of which is Messari. You can see this is the Messari overlay, which we've kind of accidentally sneak peeked at 1 or 2 times previously. But yeah, you can see that they have the real 10 24-hour volume here, which gives you the real volume of digital assets juxtaposed next to the reported 24-hour volume. So what we're looking at here really allows individuals to make a better decision and really ascertain whether or not they want to do a certain move relative to reported versus real volume. So definitely something worth toying around with. I'm starting to use Messari more and more in my daily life rather than CoinMarketCap, just kind of a habit that it takes to break since I've used CoinMarketCap for years and years now. And I'm finding it to be just as effective, if not more effective in many pieces and facets and capacities. So with that said, if you find it interesting and useful, let Ryan know on Twitter. He's a super accessible guy. And he's done a great job building Messari just as a tool for everyone to use. So really great stuff. Now, next up, we have a Singapore crypto exchange that was unfortunately hacked, DragonEX. Can the funds be recovered? Let's find out. Ultimately, some of these funds were transferred, it seems, to Bitrex. Bitrex is a third-party, centralized cryptocurrency exchange regulated and based in the United States. What this means is that if DragonEX can reach out to them in time with definitive information about who transferred what to where, perhaps Bitrex will be able to freeze these accounts that have the stolen funds and ultimately pass that on to authorities and make, above all, users of the DragonEX exchange and eventually DragonEX exchange themselves as whole as possible given the unfortunate events. Of course, cold storage is very important. Just recently, in like the last video or two, we were able to we purchased a cold storage wallet, showed you how, with help from our friends over at Smart Cash. So again, a big thank you to them. And also, if you haven't seen that video yet, go check it out. You too can go through the process and purchase your own cold storage wallet. And as said, it's very important. This is because most of the high profile hacks, like tons of money being stolen, talking $500 million worth of NEM tokens, were able to be taken from CoinCheck in Japan, a Japanese exchange, because they didn't have a cold storage wallet. So the best in practice is absolutely cold storage, not only for exchanges, but for individuals. No information as to how their cold storage processes were handled over at DragonEX, but we'll keep you up to date as we move forward with this information. Suffice to say, never a good story. Hopefully we can have the best end possible with Bitrex being able to return some of these stolen funds and cold storage having been in play to protect the vast majority of user funds. But like we said, not quite sure yet. We'll keep you up to date. Now, some exciting stuff happening on the front of blockchain law. A great saga here from none other than Caitlin Long. She is a brilliant individual. It's always a pleasure to read the material she puts out, and she's always willing to share more information. So fantastic. Always great to interact with her. And she's talking about the Uniform Law Commission, or the ULC, walking back what is known as their, the Model Acts. The Model Acts are a set of acts that were proposed by the ULC in order to better govern from the state perspective, blockchain activity and digital assets in the respective states. Well, it turns out they've now stepped back from that and are saying, hey, don't pass the Model Acts. We're going to go back to the drawing board and don't pass any legislation until we get back to you about the best approach. And this comes on the heels of Caitlin and another fantastic author pushing back against the ULC and their seemingly favoring of custodial relationships rather than direct ownership for digital assets. Let's explore exactly what went down. This individual here, Andrea Tiniano, hope I got that right. She's writes fantastic articles. I always want to get those last names right. A split is emerging in blockchain law, Wyoming's approach versus the Supplemental Act. And this is from the much earlier in the month, on March 7th. So very interesting things here. What is the Supplemental Act? Well, the Supplemental Act is actually a combination of, which you'll see here, let me find... Yep, it is a combination between the Uniform Regulation of Virtual Currencies Businesses Act, or really easy to say, URVBCA, and the Supplemental Act. Together, they're the Model Acts, and that's what the ULC is walking back from. So the ULC is actually distancing themselves from both of these acts, collectively known as the Model Acts. Scrolling back up at the beginning of the article, you can see only 4 states currently are looking at the Supplemental Act: California, Nevada, Oklahoma, and Hawaii. No states have enacted it. But the other side of the coin, the obverse of this, is Wyoming's approach. Wyoming is taking a completely different approach, authored their own approach to blockchain law, and it's being picked up by Missouri. So you're beginning to see kind of a break between the ULC's guidance and how states are actually navigating how to handle these assets on their own. So very, very interesting stuff here. A lot of this has to do with access to super negotiability, something that generally in securities only third parties are able to have access to. So that's incredibly important, and something that many proponents of Wyoming's configuration for blockchain law are focusing on, the idea of super negotiation, or super negotiability rather. So with that said, let's take a look at some of the differences and specifications between Wyoming's approach and, as said, the ULC's now defunct Models Act. Well, what Wyoming is doing is completely different. They're classifying digital assets within existing laws, incredibly important. They're specifying that digital assets are intangible personal property, so very important as well. Authorizing security interests in a range of digital assets while respecting the technological realities of these assets. As previously stated, the ULC's approach focuses much more on custodial ownership of assets, specifically with Bitcoin and other digital assets. But given the nature of Bitcoin, given the nature of cryptocurrencies, direct ownership is something that is core to the values and usability of the underlying technology. So ultimately, by implementing the Model Acts, that would kind of neuter the one of the at least biggest applicable innovations made possible by blockchain. So ultimately, Wyoming is seeking to square that circle and allow for the technological realities of these assets to express themselves in full degree. And they're also establishing an opt-in framework for banks to provide them with custodial services for digital assets, which will resolve many of the lingering issues surrounding the legal status of digital assets, which have prevented banks from becoming qualified custodians under existing law. This is going to very much ease the relationship between blockchain and crypto projects and banking entities in the state of Wyoming, something that will allow this technology and its various applications to flourish even more so. And of course, we do go into a deeper dive of Wyoming's legislation. Andrea does an amazing job with this article. Really cannot recommend it enough. Absolutely worth reading. But one of the bigger takeaways as well is, rather than looking at the entirety of digital assets as potential digital securities, Wyoming, using SF125, inceptuously offers subsets of definitions and categories for digital assets, relegating digital securities to digital assets that are just that, securities. So what they do is they open up 2 new subsets of definitions, the first of which is digital consumer assets. These are like the utility tokens that we all know and love here in the crypto space. And this is very important because these are tokens bought for consumptive, personal, or household purposes, as well as other types of digital assets that don't constitute digital securities securities or virtual currency. So it's not only the utility token kind of box that you can check, but it's also kind of the catch-all for anything that may fall in the loose ends or through the cracks. Not only that, normally the ownership of these types of assets are perfected by filing a financing statement with the Secretary of State's office in the jurisdiction of the borrower. So you got to send in a form to say you bought some utility tokens. That's so prohibitive. And as said, the technological realities take precedent. So under SF 125, lenders may also perfect by means of control, which is consistent with the tech underlying the token. So just by doing the action of buying and holding and utilizing the utility token, that's ownership. It's been perfected. So that is a fantastic shift in the Wyoming perspective and a Wyoming approach when compared to the more traditionalistic approach of the ULC. So you can see how this is very favorable for individuals in this space. As said, digital securities, they also have their own subset of Wyoming blockchain law as well, which of course makes sense. Under UCC, preferred method of perfecting a security interest in securities is through control. Therefore, it is also the optimal way to perfect a security interest in digital securities, and thereby they have super negotiability protection. So the best of both worlds, and it's true for certificated or uncertificated blockchains. So really amazing stuff there, allowing individuals to have access not only to direct ownership, but also super negotiability, while parsing out the implications for their digital securities when compared to their digital consumer assets. And the third category is virtual currencies. This is stuff like Bitcoin. Essentially what it is it's mostly like money. It's not general intangibles. It's a departure from the UCC rules in that way, since general intangibles are what you would consider digital securities, assumingly, since now these are, since with Wyoming's new law, no longer would digital money or virtual currency be considered a general intangible, but rather its own form of just that, money. So really amazing stuff there. And again, it's perfected through control, since as a medium of exchange, by controlling it, you de facto can utilize it as a payment mechanism. So very amazing stuff. As said, this article is chock full of fantastic information. But as said, this was written before the retraction from the ULC. So let's go ahead and look over at exactly what happened. Here's Andrea writing a follow-up post that is critical because the ULC reached out to her and they said, hey, we really appreciate this article about Wyoming's blockchain law. It was informative, but you mischaracterized us. We at the ULC, ultimately, you misstated our mission. We hold a different mission. And there's no mandatory use of an intermediary per se. And ultimately, you also didn't include some of the drafters of the UCC. Well, it turns out Andrea really took these folks to task and held her ground. She's an incredibly smart and passionate woman, very clearly, because she took them to task. She said, hey, this is right here on your website. The commission's worked for the uniformity of state laws since 1892, a statement that they took contention with. Not only that, she also demonstrates here at point number 2, the Uniform Law Commission takes the disingenuous position that the Supplemental Act does not require virtual currency holders to use intermediaries to hold their virtual currencies, but that such a use is purely voluntary. But what's amazing is she points out that the language explicitly states that owners of virtual currencies seeking to participate in the regulatory framework that governs trade and finance in the USA, i.e. the Uniform Commercial Code, they have to relinquish their property rights to intermediaries pursuant of Article 8, and even if they don't, it would infer a contract nonetheless as per Section 4B, meaning that if the relationship between a licensee or registrant and a user is determined as if the licensee or registrant and the user have an agreement that complies with subsection A that specifies that the law of this state governs the agreement. So ultimately, even though they don't have to do it, but it'll be done on their behalf for them, even if they don't. So Andrea really takes the task, as said, and offers a fantastic rebuttal. And perhaps one of the biggest takeaways here is testimony by Keith Rowley from the Uniform Law Commissioner for the state of Nevada, one of the 9 members of the Supplemental Acts Drafting Committee. He made a statement about the unavailability of fractional reserve banking for virtual currencies. So you have this commission literally passing guidance for laws stating that fractional reserve lending for virtual currencies is something that is very important and should be in place. Definitely alarming, as Andrea says, that the Supplemental Act is hopefully enabling fractional reserve banking, which is not what cryptocurrencies by and large, especially virtual currencies, are about at all. So this is fantastic because after this was authored on March 24th, you can see here on March 25th, just a day later, the ULC has issued a statement saying that they are withdrawing the Models Act completely, or the Model Acts completely, and that they're going to be going back to the drawing board. So hopefully that could offer you some insights as to not only some differences between the ULC's proposed model for governing in states, governing blockchains, but how Wyoming has turned that on its head and is blazing a trail for direct ownership, differentiation of different types of digital assets and blockchain assets, and really just making it to where individual liberty and sovereignty with these kind of digital assets is first and foremost, rather than the interest of some bankers as seen here, who seem to prefer fractional reserve lending, assumingly for their own interest of control in the securities markets. So amazing stuff. Here you can read the article from Caitlin that mostly summarizes and goes into the tweet thread here. I like Twitter because it's a bit more interactive. You can see what people are saying. But nonetheless, Forbes articles are a lot more formal and a bit less distracting at times for sure. Let me know what you think of this, though. I'm extremely curious if any of you out there maybe have a background in law, you're interested in this kind of thing, because this stuff just really gets me going. I think it's amazing watching how the codified governing pieces of legislation slowly but surely move into place, and that ultimately decides how we govern our daily lives. So amazing stuff there. Now moving right along, Tether is no longer backed by the US dollar. I know this is something we covered previously, but speaking of fractional reserve lending, I wanted to bring this up again. There was a comment on the last video saying that, hey, it seems that Tether is still backed. But I think there's a bit of misunderstanding between what backed versus pegged means. Pegged means, hey, it's $1 because we say it's $1 and the market agrees it's $1. That's all well and good, but that doesn't mean it's backed by dollars per se. The terms of service explicitly state that they are no longer backed one-to-one, as it used to say. It used to say it was backed one-to-one with US dollars. Then they switched over to rather saying that they have their USDT backed by other assets and receivables from loans made to Tether by third parties, which may include affiliate entities. So essentially, if they make a loan to Bitfinex, for instance, then that counts as an asset because that account is receivable, so it is now an asset. Fantastic. That can lead to some sketchy stuff, especially if it's affiliated entities. And Mitchell Moose does a fantastic job, as he always does in his articles. Definitely, Crypto Slate is up and coming, no doubt. Absolutely love the stuff they put out. Really fantastic. He points out that it may ultimately lead to an issue because Tether reserves the right to delay the redemption or withdrawal of Tether tokens, and they also back off from any kind of responsibility in case something goes awry. So this could lead to some liquidity issues, since ultimately if Tether is issuing loans to essentially back their stablecoin, then if for whatever reason there's a run on Tether or a large portion of Tether is in turn called in, ultimately what this could lead to is a situation in which there is not enough liquidity to cover the demands, which can lead to potentially cascading demands for more withdrawals, which can kind of escalate the whole situation out of control. Hopefully that's not the case, but ultimately this raises the probability for that, since previously if they were backed by one-to-one dollars, then there wouldn't be an issue. They'd have plenty of liquidity, but clearly they do not. Again, this is a direct change to the terms of services that we're seeing live, so really interesting stuff to watch this happen in real time. Another addition, Tether assumes no liability or responsibility for and shall have no liability or responsibility for any claim or any and all other commercial losses, collectively referred to herein as losses, such as loss of value of Tether tokens or the reserves backing such Tether tokens resulting from failure or insolvency of any bank, depository, custodian, borrower, payment processor, holding, etc., 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 theft of such assets, or from freezes, seizures, or other legal proceedings asserted by a government. So essentially, they're taking themselves off the hook for anything and everything. Whether the government comes and takes them down, they end up being insolvent, or anything, they don't seem to want to take responsibility for that. So taken in conjunction with some of the changes of terms of service, some of the previous slow but sure creep in changes in terms of service and wording that they use on their website, definitely weird stuff. Some individuals are speculating that the risk Tether poses to Bitcoin could potentially be very huge, since as the largest one-to-one pegged, not backed, stablecoin, it could really lead to a huge outflow of capital. And as previously said, 95% of the reported Bitcoin volume is false. So who knows what proportion of this amount of capital is ultimately using Tether on a regular basis to peg their own assets and kind of hedge back and forth between more volatile crypto assets and a stable coin. Who's to say how long it will be stable? Maybe forever. Who knows? Maybe they're ultimately treating it like a very serious bank and doing a great job. But nonetheless, from my opinion, and definitely from many speculators and individuals watching the space, Tether is a problem, and it's very worrisome that they shift their terms and services and are beginning to obfuscate from what assets they own, what the total value is, and of course, are backing away from taking any responsibility therein. Now, we got one more thing we want to show off today. Very exciting, a fantastic tool. This is something I want to end on because we just talked about some really heady stuff. I talked about how data is viewed, fake numbers in crypto, how we're going to fix that, how it's being fixed. We talked about legal guidance, huge milestones in legal guidance, how the United States, the world's leading blockchain nation, like it or not, in terms of ICO raised, in terms of stability of exchanges, reflecting real volume. We saw how the biggest entity that proposes legislation ultimately has walked back one of their biggest pieces for blockchain legislation after pushback from the crypto community. So we've just talked about two major pieces of news, talked about Tether. Let's look at something exciting and new that's being built, innovation happening in real time, since after all the stuff happening with governments is incredibly important. All the stuff happening with volume is incredibly important, but one thing you can't fake is people. People can sometimes be fake, but one thing that's not fake are the dudes that are building balance. This is awesome, guys. You can essentially use the Balance wallet to connect your Ethereum wallets and keep track of your tokens, your loans, your investments. It's your one-stop shop for finding out what's going on here, and it is awesome. It's built by Rick Burton. He's doing some amazing stuff here. Shout out to Rick. And here you can see the, might have to F5 this. Boom, what you see when you go to Balance Manager. It's currently in beta, and man, it's cool. You can connect to your Ledger, your Trezor, Wallet Connect, or MetaMask. For the sake of example here, going to show you how to connect to MetaMask. Boom, I already signed in. All you have to do is enter your password. Boom, this is what you see. Look how smooth this is. You have your DAI stablecoin. I bought one DAI for an example. Got Ethereum here. This is really smooth. So let's go ahead and just do an exchange, just for the sake of argument, just to show you how easy this is. Select a token. I don't know. What do you guys want to buy? I'm on the Brave browser, so we'll buy some BAT tokens. I'm going to buy 2 BAT tokens. How much is that going to run me? Oh, super negligible. Sweet. I'm actually going to buy 3. Boom. All right, there we go. So now I see the wallet that's going to MetaMask green light online. Gives me the total cost. I'm going to hit buy BAT. What do we got? Boom. That easy. Hit confirm. And it even gives this nice little loading bar. Since we as humans, sometimes we can be a bit impatient. You may not want to admit it. I'm happy to admit it. I want things fast. That's why I go through the drive-thru every so often. Try and stay healthy. Don't do that too often. So this is why. You got a nice little loading bar. Gives you something to keep you occupied. Boom. 1 transaction confirmed. View transaction. Takes you right to Etherscan. Boom. You can see it's still technically pending just a bit. Boom. It's confirmed. How fast. How simple. How seamless. Now we're going to go ahead and click the X. Failed to get account transactions. No worries. I'll just hit F5. Refresh my browser. It should display. Boom. Immediately. 3 BAT. In the Balance Manager wallet. How cool was that? I mean, that took way less time than explaining implications of blockchain law, am I right? And you can see, just in case you're wondering, they do have a Balance token. It has $0 value at present. It's just used to unlock cool stuff in the Balance ecosystem. So they are trying to create a community from the grounds up, something that truly embodies the notion of not hodl, but buildle. That one's really hard to say. Build, essentially. It's like the funny version of BUIDL, you know, the corrupted version of hodl, old crypto joke. But here is their Twitter. They're really blowing up. Fantastic stuff. Absolutely love what they're doing. Yeah, check it out. Play around with it for yourself. They're in beta test. They're going to be releasing on Android here in the next few weeks. So excited to check that out. Again, big shout out to the guys building this. Here's the man behind the magic, Richard Burton. Shout out to him as well. Here he is freaking parasailing. That's cool. I actually never noticed that. What's up, man? That's cool. All right. So with that said, that's all we have for you guys today. Thanks so much for checking this out. If you use the Balance wallet, let me know what you think. I'm sure Richard would love to hear as well. I think it's freaking neat. It's super cool. So yeah, this is all we have. Keep an eye on this Bitcoin trading volume. It's going to be a big thing going down the pipe coming forward. You're going to see that, a lot more of that, and I think it may ultimately impact CoinMarketCap. And we're going to keep an eye on Masari as well. So thanks so much for watching, guys. My name is Paul, signing off. We are Cryptide, and remember, the tide is rising, as is the impact the crypto community can have on blockchain law. Do your part and work hard. Much love, guys.